Welcome everyone to another episode of Mere Finance. We started the year 2 weeks in after Donald Trump became president of the United States with a lot of tariffs, a lot of trade war. And it's interesting how the markets are interconnected. So today we're going to talk about the Swiss National Bank and the S&P 500, which is the index that follows the 507 companies in the United States. We can see in the pandemic how if a place closed a mine or if a place closed like a manufacturing plant, it affected the whole supply chain across multiple latitudes and across multiple countries and industries. So the global financial system is far more vast and its understanding is a challenging endeavor. It's extremely connected. That's why when Trump says we're going to input tariffs, it actually has a huge repercussion, not only in the economy of Canada and Mexico and the United States, but across all those countries that provide those raw materials so that Canada and Mexico can provide their finished goods. So one man's trash is another man's treasure, that's for sure. So the S&P, we know, is the heart of the U.S. economy. Some people say, no, there's a difference between the financial markets and the economy. But the S&P really shows not only how the biggest and most successful companies are doing in the United States, but also the perception and optimism of the U.S. investor and U.S. consumer. If people consume, the S&P 500 goes up and investors buy it and then rinse and repeat. Now, the Swiss National Bank, as every other central bank, has two main concerns, right? They have to maintain unemployment correctly in a good level and have price stability. Other national banks also have to defend their currency, but they do it through monetary policy. Fiscal policy is mostly used by the governments in charge. So you can see here the exposure of the Swiss bank to the S&P 500 stocks as of the last view. So you have 9 billion to Apple, 9 billion to Microsoft, almost 9 billion to Nvidia, 6.54 to Amazon. So their balance sheet is pretty heavily exposed to the US, so at least they own 21 stocks, more than 1 billion in face value, in market value on those stocks as of 9:30. And it's a big commitment, right? So in total, they own $174 billion in US stocks. So, and if you can see, the U.S. National Bank has the ability to print money. So people will say like, all right, well, this creates an issue because if you print money out of thin air, well, we know it's not thin air. It's to be backed by political stability, by an army, etc. Now, although the Swiss, they don't have an army, but they do back their Swiss franc based on their free economy and their libertarian government. But they can really print it out of thin air, use these francs to purchase the US dollar, and then employ these new acquired US dollars to buy American stock. Sounds easy, right? Rinse and repeat. You get rich and then you sell. And you make a ton of money. Well, not necessarily. Although there is some truth that the monetary policy and the S&P 500 have some correlation. Here is the ratio between the S&P and the M2, which is the money supply in an economy. The money supply goes up. Usually the S&P 500 goes up because there is more money in the economy chasing those returns. And this is the Swiss franc to the US dollar spot exchange rate. You can see somehow stable. It was pretty stable from the 2015 until like 2023, between a band of 88 cents to maybe 103. But recently there is some depreciation in the Swiss franc, right? And since 2023, we have seen from 94 to 84 all the way down at the end of third quarter in 2024. So, but it's a good range, right? The Swiss franc has become a little weaker to the US dollar, but it's manageable. It comes in cycles. It kind of has like a band. And here is the red line is the spot, but then the blue line is the trend. If we will get to move the S&P 500 into Swiss francs, how would it value? You can see it goes up as well, and it actually goes up bigger. So the benefit here of the Swiss National Bank is they not only are getting the returns of the US dollar, of the S&P 500, but because their currency is depreciating, then the returns go down because they have to go and sell dollars and buy dollars. What they sell in dollars, and then they bring that, and those dollars are actually stronger to the Swiss franc, so they're actually getting more Swiss franc. So it's a good business for now. However, we'll see if a country prints too much money, there is huge inflation. But also when you buy too much of an asset, you're too exposed, and this self-reinforcement mechanism will work good on its way down. If you're too exposed to the S&P 500, you can collapse. We talk about how Mexico did that, and it just collapsed because it couldn't defend its currency. So currency appreciation, although has some values as well, some negatives. You have hindering exports because it's harder for other countries to buy your products. You can experience deflation as well if there's too much, your currency is too strong. And also tourism, recession, other national foreigners cannot come to your country and spend as vividly. So at the end of the day, the long-term collapse of the American markets is that everyone will suffer. The Swiss bank, for example, will suffer. So there is an interconnectivity that President Trump has to be aware that everyone will suffer if he does something incorrectly to the economy. But I think at the end of the day, we can just see how complex the system is, and that the Swiss bank is not going to just print money to buy and buy more because the exposure becomes too big, and then basically they will give their currency power to the president or the Federal Reserve of the United States because their exposure is too big to the US that actually whoever decides the future of their assets will be a different entity, not themselves. That's why they cannot just print money out of thin air. But it's a really good case of study. So let us know what you think, and don't forget to subscribe. We'll be here next week with another episode of Mere Finance. Thank you.